자, 오늘 방송의 마무리도 역시 오미주님께서 준비해 주신 비디오 클립으로 마무리하도록 하겠습니다. 오늘 비디오 클립은요, 우리가 주식 투자를 할 때 여러 가지 지표라든지 평가 항목을 보면서 이렇게 투자의 방향을 설정을 하잖아요. 예를 들어서 금리가 움직이는 모습이라든지 인플레이션이 발생할 것인지 안 할 것인지, 뭐 기업에 대한 텍스가 세금이 올라갈 것인지 안 올라갈 것인지, 뭐 이렇게 여러 가지 생각이 복잡한데 사실 가장 중요한 것은 시장에 얼마나 많은 돈이 풀려 있는가, 그 유동성이 가장 중요하다라는 그런 얘기를 해주고 있는 그런 영상입니다. 한번 관심을 가지고 끝까지 한번 시청해 보시면 좋을 것 같고요. 제가 오늘 방송 가장 앞부분에서 지금 델타 바이러스의 확산 추세에 대해서 우려의 목소리를 여러분들과 공유를 했는데요. 우리가 지난 2020년 3월 달에 어떠한 일이 있었는지 한번 되돌아보는 계기를 마련했으면 좋겠습니다. 그때 주식시장이 어떻게 하락을 했고 또 이제 다시 회복하는 모습을 굉장히 빠르게 보여줬잖아요. 그때 이제 주식시장이 회복을 할 때 어떠한 부분에서 좋은 모습을 보였는지 이러한 부분도 우리가 다시 한번 복습을 해본다면 지금 만약에 델타 바이러스가 굉장히 확산이 돼서 주식시장이 약간 머뭇하는 모습을 보였을 때 어느 부분에 집중적으로 투자를 하는 것이 좋은 결과를 나중에 얻게 될지 한번 전략을 세워볼 수가 있다는 거죠. 저의 개인적인 의견으로는요, 혹시 여러분들 중에 경기 순환주, 그러니까 이제 경기가 회복되는데 베팅을 하신 분들, 아니면 인플레이션이 생긴다는데 베팅을 하신 분들께서는 다시 한번 이렇게 전략을 조금 리뷰를 해볼 필요성이 있지 않은가, 이러한 개인적인 의견을 한번 피력하고 싶습니다. 물론 저는 전문가는 아니고요. 뭐 우리가 이렇게 주식 투자를 할 때 우리의 사는 환경이 어떻게 변화하고 있는가를 지켜보는 것이 굉장히 중요하다는 취지에서 말씀드렸다. 이렇게 이해를 하시면 좋을 것 같습니다. 자, 오늘 방송도 마지막까지 함께해 주신 모든 분들께 다시 한번 진심으로 감사의 말씀을 드립니다. 내일은 주말이잖아요. 주말에는 조금은 다른 내용의 방송을 가지고 다시 인사드릴 수 있도록 하겠습니다. 우리 모두가 미국 주식 투자로 은퇴하는 그날까지 다 함께 화이팅입니다. 행복한 하루 되세요. 감사합니다.
So I want to start with you, and I want to stay on this rate story. I think it's the story of the market, clearly. And you got caught the wrong way in a trade that you had, which you are now out of. Tell us.
Yeah, TBT, which is the ultra, which means that it's doubling the size of the position, using leverage essentially. And I was betting on short treasuries, specifically around the 20-year. Didn't work out. As you may recall, when I went into the trade, I said, look, I think yields are around 150, 1.5, 1.55. I said, look, my downside's 1.4, and my upside in terms of rates, which means bonds would, of course, decline for rates to go higher, for yields to go higher, was about 2% by the end of the year. And when it got to 1.4, I said, okay, I'm there, I can hold it. But then it started trading down more, and particularly being in these these leveraged ETFs, which I never do, but did here because the moves in treasuries so minuscule. You get caught, you can't catch up. So I can't tell you that I specifically understand why yields are where they are. I can't tell you anybody's got a good reason. So when I don't know what's going on, I tend to sit back, get out of the trade and examine it, and I don't mind coming back in, and that's what I'll do here. And in fact, the world could change completely at 2:01 because we get FOMC minutes at 2 o'clock, and if they have even a more hawkish dialogue than we heard in the press conference, I think you'll see the reversal in yields.
You know, Joe, I talked to somebody, a big investor earlier today on this issue of what's the deal with rates? Why do they keep moving lower? The market, as Steve said, seems to be confused what to make of that move. This person told me straight up, just too much liquidity in the system. It's about nothing else than that. It's not about peak growth, because if you look, let's just say for argument's sake, at inventories, which are at a 5-year low, there's going to be a massive ramp on inventories into the fourth quarter. You're going to have a big economic boom still to come because of that drop in inventories. Don't make too much of it. Straight simple. Long stocks, short rates. You're going to have a boom. It's all about liquidity and nothing else. Keep it simple.
And I don't have to worry about inflation in that conversation as well, I guess. But I
Not
think
now.
Steve is
Not now.
indicative.
That was part of the conversation
Exactly.
too, and that the market doesn't care about any of that in the future. It cares about the here and now.
Correct. And I also think in that conversation, we're still short 6.7 million jobs from the pandemic. And the question has to be, Will you get all of those jobs back? And I'm not sure that you will. But I think, Scott, Steve is indicative of the entire positioning collectively for fixed income. Find me someone who really believed that rates were going to fall to 1.30 and didn't think rates were going to skyrocket above 1.7 towards 2%. So I think a lot of this is about positioning. I agree with you. I think a lot of this is about liquidity. And I think overall, this is just a return to where the economy really is centered. This economy is an intangible asset economy. It's fixated on growth. Growth is 40% of the S&P 500. That's never going to change. And to think that you should be moving away from these growth businesses is foolish. And I think that's what a lot of institutional money has done. The evidence is there and the data to support it. Institutional flows in the month of April and May took positioning to mega cap technology and reduced it below benchmark. And now with rates moving lower aggressively since June 17th, they're raising those allocations once again. And I think that's the right strategy.
Let's just say, Jenny, that that view is correct, that this is about nothing but excess liquidity. And that's a bullish sign because the liquidity is not going anywhere in the very near future. The economy hasn't peaked. I gave you the stat on inventories. We're still yet to fully ramp and fully get out this summer and all of that. You believe that view?
I do, but you made a really key point, which is the liquidity isn't going anywhere in the very near term. But the liquidity is going somewhere in the longer term. And what we know from a couple weeks ago from the Fed meeting was that they started to talk about raising interest rates. We all know that that was their way of paving the road to talking about tapering. And the collective wisdom right now is that tapering will probably start in November, December, maybe January.